prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position.
Well, damn it. My thing is not detecting the... Give me 1 second here.
The market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well.
Or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and BYDFI numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal, for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers has demand for workers in the form of, let's call it, just say payroll jobs. That number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody, and also from a dissenter, is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to, slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is, substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower.
To look through core goods inflation being driven by the judgment that during the pandemic, expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I don't think, I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, what do you, well, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good for if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, you know, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
So,
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate
Good
below
question.
4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of the tariff. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
That's a good question.
How concerned am I that say that again?
The wait-and-see approach.
That's a good question.
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
Well, so that, where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay, this delay though, where you're saying is a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover though to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all the discussion of how they're going to, companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just go across the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate, or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, and that will be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. I mean, we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting, will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down
I think
closer to 2?
We'll look at everything. It's, as I mentioned, a pretty reasonable base case is that this will be a one-time price increase, and in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right, so we don't. If we cut rates too soon, maybe we didn't finish the job with inflation. There's history is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I don't know if there's been any discussion about that at the meetings and how, to what degree that may be complicating your attempts to get inflation back to target. Thank
So
you.
this goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I wouldn't say it doesn't come up. The transcripts when they come in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the US economy? Thank you.
Yeah, we're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But we really need, the government data really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And we're not going to be able to substitute for that, but if we have to make do with what we have, but I certainly hope that we get what we need.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Sir Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing, but so generally, and if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it it's true, and it was, again, right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about in the sense, Governor Water said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
I was just, man.
So,
Sometimes you get bad luck with certain things, but nothing to do with trading or anything. Something irrelevant.
I think what we know is
This guy is so boring.
private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW
If you take the
adjustment seriously, it may be even low, maybe close to zero.
okay, we're dumping.
But the unemployment rate was still low.
It's just rinse, repeat, guys. Rinse and repeat, like washing stains off of clothes.
It's in balance, oddly enough. You've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that, because of immigration policy, really, the flow into our labor force is just a great deal slower. And those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Yeah, dark chocolate is so good, guys. That is so addictive, dark chocolate. Don't be drinking no milk. Don't be eating no milk chocolate.
One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So,
Oh wow, I didn't even see there was a.
an economic go-around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go-around all the way around the table. Everyone gives their views. So the discussion around policy was the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that for the reasons that they're going to express. I won't tell you the reasons they'll issue some kind of a thing the next day or so. But that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock. And it's probably not surprising that there would be differences and different perspectives on
That's
that,
ridiculous.
different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. I said that's why we think policy should be restricted, is because, you know, inflation is above target. When we have risks to both goals, and one of them is farther away from goal than the other, and that's inflation. Maximum employment's that goal. So you have to, that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restricted. It should be more neutral, more you know, a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and you know, we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Thank you for taking the question.
Oh man, you don't say.
A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to
Oh boy.
1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I'm just wondering if you look at that, you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak. And the inflation numbers from GDP today came down 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. BDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower. But, you know, GDP is bumpy quarter to quarter, half to half, and often gets revised, you know, after the fact. The labor market data we still think is continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages.
Yeah, things. I mean,
still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation, because you're being pulled in 2 directions, and you have to decide which of those it took to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not gonna say that. No, I just think we're gonna need to see the data, and it can go in many different directions. The inflation data and the employment data, and we're gonna make a judgment based on all of the data and based on that balance of risks analysis.
others. Oh boy. Well, ETH versus others is doing what?
Thanks, Chair Powell. Greg Rock from Market Watch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term.
Powell needs to stop talking.
I was wondering if you had any update for us on a decision on that.
So.
Sorry, I do not have any update for you. Thanks very much, everyone.
Okay, he's done. The lion is gone. He's done. It's over. It's all over. The event has now ended. I don't know. I mean, it's kind of just typical. I was kind of zoning out and reading about something happening that was completely irrelevant to everything. So altcoins are kind of bleed. Let's look at others versus Bitcoin. So we know markets are down, but I mean, nothing goes up in a straight line. That's a good thing to realize. Hitting a decent point right here on others versus Bitcoin. So now you could argue price is already factored in, because it instantly kind of gets factored in. I think the big question here is this become a higher low? And I think the answer is probably yes. where does this end up? I mean, I think that the two places you likely would hold are 33 and 35. So there's that. I'm trying to think what else here. I don't know. Yields, I don't even think I think this is going to generally head down, but it's taking its damn time, you know what I mean? Making lower highs generally from January. Not too much happening there. And I would assume that the market would probably get a little bit more boring here. Now let's do our old, well not old, but our trusty fixed range volume profile here. It's losing that area. Bottom of the range, 3600. I could see us hitting there. Blood diamond in the 90 minute. I mean, that's not the worst kind of place to have a blood diamond. Yeah, some of these are playing out to a certain extent. I think he would hold 33, but we'll see. Others kind of slightly, I mean, what do you expect for altcoins? I mean, they always find a way to disappoint, at least against Ethereum. And Bitcoin lately, or for many years now. But money flow kind of coming up. Yeah. So let's see here. Trigger wave. So still rare bear bullish signs. I mean, 4-day it's essentially confirmed unless you really crash. Although there are probably some people, if you look hard enough, who will tell you that we're really going to crash and go to $10 next 4 days. I think it's pretty unlikely, but we'll see. But no, I think we're pretty good. I think we're still fine. I mean, yeah, double bottom type situation, this area. Let's take a volume profile quickly here. Fixed range volume profile. Interesting. Okay, maybe I don't think you're going to go down that low, though. Yeah, so we'll see what happens. Chain link as well, losing that area, so... Yeah, based on some of these money flow crossovers, I mean, you know, you could... I mean, you always are used to consolidation, though. Like, you come up, you consolidate, then you're... You know what I mean? Like, you come up, you consolidate, then you broke down. You come down, you consolidate, you broke down farther. Come up, consolidate, broke down, you know? Or, you could argue, like, come up, consolidate a little, come on, you know what I mean? So this is kind of like, could be like that, you know, and then you come up farther. You know, there's that possibility. So, yeah. And if you guys want to lose all your money shorting, no, I'm just kidding. Check out the links down below for BYDFI. Bitunix. Oh, wow, this is almost going to get stopped out in profit on ETH. Maybe it won't, though. That was the big place. That's the thing for ETH that I was trying to kind of hopefully hold, like that kind of area, and so far so good. I think it probably will get stopped out. Usually when you get close to an area, that's kind of where your stop loss is. It does hit it, but not always. Sometimes you survive. You know, $450 billion market cap for ETH, $460 billion market cap for ETH. I mean, I think from where we are right now, we got a good shot of getting a double into October to the end of the year. So I think we're still good. But people generally always want more. I mean, let's just follow this general path. That road leads to sometime in October, if you do follow that. And I think you might. So I think we're okay generally. SWI coming down a little bit as everything else hopefully makes a higher low here. Gotta realize though, price is kind of already factored in for whatever the hell Powell said. I mean, it doesn't mean it can't go, doesn't mean there won't be more of a sell-off, but there's that. I guess some people argue, you know, there's greed, you know, I mean, no one knew what SWI was until frickin' probably November of last year, or, you know, later last year, you know, those kind of areas, so, yeah. That's, I mean, generally what happens, it gets exciting, then boring for a while, then slowly recovers, or never recovers, you know. You know the deal. Curious, I know Crypto.com was doing well, I think that's down a little bit, but, I mean, still generally up, if you know what I mean. I mean, it's not that, like, you know, we're not in that terrible of a situation or whatever. I don't think. I mean, I think you need corrections. I mean, this could probably go all the way back down to 12 cents and still be all right. I mean, I don't even think it would go that low, but we'll see. I mean, I think things still look very good in the macro, so, you know, he's got to kind of wait a little bit here. So yeah, I think we're all right. Salami. I don't know. I mean, it could go down a little bit more. Could even go down to 150 or something. I kind of don't think it will, but it can. And then potentially, come up a little bit more. I mean, it depends how you think. If you think August is going to be the red month, which is kind of was my original view, and then I kind of got the idea of ETH potentially hitting a new all-time high, and that kind of 2 more weeks. So if you think August is going to be the red month, it would make sense for, let's just say August is the red month. Let's map that out. Let's say August is a shit show, which I think, shout out to Nick Cipher, Flopping Groper, I think he was talking about that. So let's say we come down a bit. Probably not anything too insane, but, something like this into middle end of month or something, 2,700 again, let's say. September and October probably will be green. And there you go. September and October being green, you get up to those areas, you still get up to those areas. So I think regardless, I don't think it's the end of the world. It is annoying though, I'll tell you that much. I mean, it is annoying to have to wait. Nobody wants to wait. I mean, the quote that was Warren Buffett or whoever the hell said the quote, trading is taking away money from the impatient to the patient. I mean, that's very true, at least to a certain extent. I don't know if that's every case, but, money from impatient, or taking away money for people with just bad judgment who get liquidated, But yeah, so that's that view. So I think there's a little bit more patience. I think the 3 days good. I mean, a third rejection from this point, a triple top is a pattern, but I don't think you're going to break down to freaking 700. I think you're more likely going to continue forward. So yeah. I mean, it's a Moria daily. I mean, these things are more like consolidation signals rather than like bad correction signals, I would say, because when you look at the higher time frames, they still look okay. I mean, I'm trying to think, like, what kind of, if you have a correction like this, I mean, that would be pretty annoying, but not the end of the world. I don't think that would happen, though. I think you may be a little bit boring, though. I mean, you could have a boring month. I mean, the summer lull is kind of boring, too. I mean, July has been pretty exciting and then a little bit boring, I mean, it's been generally, for Ethereum at least, pretty damn exciting, since kind of the bottom there. April 6th, then you're up to 1,600, and then you jumped up to 2,600. I mean, it was a fun situation, People got excited around, end of May right there, and into the conference, a little bit of sell-off, and then more excitement in this month, July. I mean, let's just look at the damn July return for this. This was a freaking, it's 56%, not half bad. I think it will keep going, but you may need a little bit of consolidation. So yeah, I wanted to look at crypto, fear, and greed. So let's see here. Oh, wait a second. Okay. That was my, yeah. So, holy. Okay. I don't know how, I mean, people are putting money on no change for September and no change for October. My theory is, though, if you wait until October to cut rates, what happens? I think that may have marked the end of your damn bull run, but we'll see. And I think it's kind of almost better for us that rates aren't being cut. Oh, let's go. Okay. So based on what he said, yeah, that's getting factored in though. So October's the cut. Yeah, October is the cut now. And that's what I've been saying, guys. That's what I've been saying. Evan Aldo was right about this. I'm not always going to be right, but Evan Aldo was right about this so far. I mean, that's basically 50-50. It can change, but October could be your cut, and that may be the sign to get the hell out of the market, especially if things are very high. It's kind of ironic, the opposite of what you would think. It could be like last year, though, where, you know, rallies into December or whatever. I'm just curious about. Interesting. So they think there's going to be a cut in October and December. That's interesting. So I'll bring interest rates down a little bit. So probably before that October, your interest rates will be down. Your yields will already be factored in. Interesting, interesting. Let's see here. Just thinking here. That jump up. I don't know, this looks like it really wants to freaking jump up. Your alts really do look like they want to jump up. I mean, I know they're coming down a little bit now, but I mean, they look like they want to do some damage. This could be a little... Yeah, now they're coming back up. I mean, everything's already... The lion has finished speaking. And I thought Trump said there would be... Trump was saying there would be a cut in September. I don't think so. That could change, but... And it's kind of... I'm happy about that, because that could be a damn good sell signal in October. I'll tell you that much. That could be a sell signal and a half. Bitcoin at under 50K, ETH at, I don't know, wherever that, 7K, 8K, who knows, 6K. Get the hell out. You know, convert to S&P 500, gold. Don't convert to the US dollar, in my book. And there's always better things to buy than the US dollar in my book. But, you know, that's just Evan Aldo's opinion. We'll see what happens. You know, I mean, you look at, let's just look at the freaking, that's, I called this bottom too. I called this down. I was talking to somebody here in Finland. And he was like, US dollar's down. I'm like, it's coming back. It's going to jump. And it has jumped. I don't know if it's jumped against the euro. The gyro. It's jumping against the gyro. No, it is. It is coming down a little bit, which is kind of good. Yeah, we want the Dixie to go up for foreign currencies, whatever. But yeah, not down that much, but you know. The high point there. Sell all my spot positions, Wonderbar. I'm going to start scaling out in October, most likely. It does depend where prices are and how things look, but most likely from October to December. I would guess, I mean, in some scenarios, I could be all the way the hell out in October, but not, like, you know, I'll keep some stuff, you know what I mean? A little bit. It depends. It depends how much money I want to put into, you know, other things and whatnot, you know. Yeah, there's always things you could kind of put money into to... You know, I mean, if you put some of your crypto gains into your, you know, IRAs and crap like that, retirement accounts, you offset some of the tax burden for now. You know, on your income or whatever. So there's things. I mean, you do have the Bitcoin ETFs that you could buy there too. But yeah, there's counterparty risk. I mean, I wonder what Sailors said about like 6,800 there. Dump was it for now. I mean, based on the FOMC meeting, that's already factored in. You know, everything he kind of said is already like factored in. So if I had to guess, yeah, most of this probably is kind of over. I mean, you're either going to break upward or downward here. I would guess more likely upward. But it could be a little bit boring for a few weeks, then break upward, or hopefully upward for like 2 more weeks. But I don't know. And the thing here is like, let me just like draw out this little itty bitty, because people were a little afraid. I mean, they opened some shorts, now they're all happy. You know, my shorts did good, yada yada yada. Nope, not always, but we'll see. What's up, AZTV? What do I think of SPET? I don't know what Sailor's gonna do. I mean, you know, I think that. I mean, I don't know if he'll sell. He might, but who knows? I don't really know about that. Some people, his reputation's been a little worse lately. True wave right there. I mean, everything corrects, guys. I mean, this is probably a 50% correction right here. Let's see. Volatility's nuts. This could be a good buy for this, actually. I don't know if I would personally. I mean, I got a lot of ETH already. I don't really. This in the sequel's always worse. I don't know if this is really my thing, but it could be good. Yeah, I mean, I wouldn't put all your eggs in one basket. It could be good. Yeah, this could be a jump for this. I mean, I'm trying to think, like, what is. I'm trying to look at some points for it. $76 billion Bitcoin, yeah. Well, they're gonna sell. Why do you think they're gonna sell? I don't really follow Sailor as much. I mean, I think this will eventually break upward. I could see this hitting 700, maybe even 850, somewhere in this point by end of year. So I think there's more potential. I mean, if this does, 100%, I could see Bitcoin at 150, maybe 160, depending. It did peak out before Bitcoin in frickin', that's the thing. It could be, if you're basing it off of this, yeah, February 21, it could be done. Based off of that, it could be done. I kind of think it'll keep going, though, but we'll see. And this is really the shareholders that, earnings report tomorrow. Well, it's not. I don't think that affects this too much. It could be good, though. I mean, the whole company is just Bitcoin. It's not a profitable. Like, I think all they do is Bitcoin now, right? They just buy Bitcoin. It's not too much. Like, Sailors just buy Bitcoin. Others is hitting a pretty big point, so... Or Others versus Bitcoin, excuse me. So I think we're still okay. We may consolidate and then eventually jump upward. So I do not think this is the end of the world or the end of anything for that matter. So, yeah. Hope you know. Let's see here. How about traditional markets? Are they doing anything? Yeah, it's slightly down, but it's not like, it's just more of a consolidation, I think. I think you're going to keep going generally into end of year. I don't know what I don't know what Trump's going to say. After this, probably just going to call him a loser again. He can't really do too much. This guy's a loser. Can't really do too much, Trump's going hard in India. I thought they made a deal. It's never over with that. Let's see if Connecticut's number one. Connecticut's normally number one. Yes, sir. Yes, sir. 1 mil. 1 mil a year. Massachusetts, jeez. California, you wouldn't think they're above California, you know what I mean? Because all the freaking people in California, I guess all the homeless offset the New Jersey, New York, Florida. That was not, in recent years, that was not. Freaking why? Yeah, every rich person's got a damn bunker or something. And yeah, they like to ski. Wealthy people like skiing, It's a wealthier thing. It's an expensive sport. You don't have to be wealthy to do it, but there's something about it that wealthy people like ski. I don't even know if there is skiing in Wyoming. I know there is in Colorado, but is there skiing in Wyoming? I don't think it's not as known as like Colorado. I think it's better in the Alps and like Switzerland or whatever, but takes less. Interesting. This was like, 10 years ago, it was probably like 300K. This is all the states, right? For being in the top 1%. I would say pre-COVID, it was probably like 400K. Like, it's really, really gone up. Let's see, like, Texas, 700, yeah. But it's kind of, you're still in top 5% if you make like 200, 250, 300, something like that. But man, value of that money. I'm just curious, has anybody in the chat made, I'm sure a couple of you might have, at least one of you has made over $1 million in 1 year. Definitely one of you definitely has. What's up, Jay Sherlock? The market is being away, but the Fed is doing nothing. Yeah. I would think, yeah. My guess is that if you're a big 4-year cycle person like myself, once they finally do cut in October or whatever, once they do finally cut in October, you know, yeah. It's like a FE for that. I'm just curious about the ETF, like, because you know there's some money that bought, you know, okay, so you're slightly down there based on that, but the 42 is the high December. But I think she'll get there, you know. There's going to be consolidation, guys. I mean, I'm not too pessimistic. I mean, sure, maybe we'll go down to 3,300, but I ain't that pessimistic yet. Climb the wall of worry. You know. Or the damn tsunami. What was that show? There's like some show. It was like T as in tsunami, and the person's like, "What the? How? That's not a good." T as in Tyrannosaurus. Interesting. Apartments rents are dropping. National multi. Vacancy rents are down. Interesting. That's so slight, though. New apartment supply. Yeah, Powell said there's still. What's the deal with real estate supply? Powell said it's still. You know, there's still a lot of. A lot of frickin', you know, no supply. Softest rental rents down. Wow. I guess that's interesting too, because if you're looking to move somewhere, but that doesn't always follow the, it might be a good time to buy in Texas. I mean, it might be Austin's a good place too. I mean, I've only been there once, but I feel like if I had to choose to live in the U.S., other than like Miami, I'd probably pick Austin or trying to think. I mean, maybe Vegas, you know, that surrounding area. You know, cool to have a ranch in Wyoming or something. Real estate's in the shitter. It's like, it depends how you, like, I mean, that's the thing too, because you look at Miami real estate futures, I mean, it's been topping, but like, the thing too is like, let me ask you, Johnny M, like, you remember, like, in your lifetime, other than, like, I mean, the corrections before '08, you know, I mean, it depends where you were, obviously, but '08 overall, 30 to 40% correction. I think California and New York City didn't get hit as hard. Florida got hit the hardest in that. It was like a 50% correction. But real estate corrections before that, I mean, other than freaking Great Depression, where it came down, 60% or something ridiculous. I mean, not early 90s, late 80s real estate correction, a 20 to 30% correction, like, I mean, even if it does, like, everybody's like gets so excited and so, you know, it's like, it's hard to explain this, but it's like this is gonna crash. You know, I mean, everybody like told me my entire life since this bottom, it's gonna crash, you know what I mean, it's going back down, it's not the body, you know, it's gonna do this, it's gonna doomsday, you know, end of times. And it's just like, I don't know. I would follow the 18-year real estate cycle thing. You know, 89 to 91. How much did it come down approximately? And the one before that was approximately, 18 years before that? I mean, that would have been, let's see, early 70s. It probably came down a little bit, you know. 18 years before that would have been mid-50s. It probably came down a little bit. And the damn one before that would have been, well, let's see, Great Depression, kind of. 17% mortgages. Did it come down? It came down probably a little bit there. It was probably like this, though. What was the correction in the early 80s with the 17% mortgages? And the thing, too, guys, is like, you know, a lot of, like, the boomers would say, you don't remember my day. You know, we had 18% mortgages, but, like, you know, you don't remember my day in the Great Depression in the 1920s. You know, look at this. Look at this. We're even higher than we are. Higher than we are now. 82 was not, if I remember, 82 was like, that was the real correction was 80, it was 5 to 7 years after 82. So let's see here. So they start, that was 5 to 7 years kind of after that. So that was late 80s was when it really did top out. This, I think it still went up with these rates. It might have went a little bit. 20 to 25%? Really? Was it 25? In the early 80s? I could be wrong. I think that was more the early 90s was 20 to 25%. Late 80s, early 90s. Based on the cycle. I mean, it was probably, it depends where you are. I mean, that's the thing, too. Real estate is such a freaking, because it's like such an individual thing. You need to find an individual who wants to buy your trailer park. You know what I mean? You need to find that individual that wants to buy it. And it's different areas, you know. Some areas go down or up a lot more than others. So yeah. Right there. Yeah. I'm just pretty, I know some of you guys hate the mouse. 80, 86. Yeah, I know they were high, yeah. No, I know they were very high. I'm looking at the damn chart, yeah. Not a fun place to be. I mean, a lot of that was from, they were trying to get, Reagan wanted to really get it under control, and, you know, he did so, and, you know, things got better to a certain extent. I mean, they were still high throughout most of that era. I mean, usually when they jump up a lot, that's the thing. Like, when it jumps, it's not going to go down that much anytime soon. I mean, it may go down to, like, you know, 5.8% for a 30-year mortgage within the next year or two, but, you know, the days of frickin' 4% mortgages, I think that's a while away. That's like early 2030s or 2030 at the. That's probably 4 to 5 years away. 5 year to 15%. Yeah. Yeah. So 20. Okay. So you had a double. That's interesting. How it. Yeah. But if that's true, that's interesting. That's the closest like real estate drops in. Because if it dropped in the early 80s, then it dropped again in the late 80s, early 90s. That's a little unusual. Yeah. And there's other things like debt to GDP. The interesting thing about debt to GDP is like, usually everything goes belly up. If you look at like, you know, the British Empire falling apart, that was 200% debt to GDP. We're about 130% right now. And then Greece kind of went belly up when they hit, this was 10 years ago or more, I forget, but when they hit 200% debt to GDP. We're going to hit that likely in the 2040s, 2050s. Like, I think Trump has no intention of really doing anything major to lessen debt to GDP, you know, obviously based on kind of what Elon, you know, said, the big beautiful bill or whatnot. I mean, it's still spending at, you know, at COVID levels without them actual, you know, giving people checks, you know what I mean? It's still a very high amount there. I mean, thinking here, yeah, it's, I mean, I would think 2030s, you know, you'd probably get the Democrats, and again, economy probably won't do as well. Then you get more entitlements, you get more social welfare. You raise taxes back to what they were during Obama, Clinton, you know, that type of shit. And then, 2040s, 2050s are really where, probably because of debt to GDP causing inflation, America losing its place as the world power, then he would cut a lot of stuff. And that's kind of what happened. I mean, there's still going to be entitlements to Social Security and Medicare and all that. I would think the 2040s, 2050s, S&P 500 probably would still go up. I mean, who knows if it really goes up that much in terms of buying power, but it probably still would do relatively well. I think Bitcoin would do really well in the 2040s, 2050s, especially with the changing world power. My throat is a little itchy, allergies. But yeah, that's what I'm kind of thinking. I think things generally kind of follow that pattern. The thing too is it's like, just that human, when you watch a lot of news, it always seems like doomsday and all that, and it's really only, so far a frickin', 6% correction on ETH. I mean, okay, some alts did worse, but I mean, not your alts. Came down a little bit there. I think this generally should come up. I've looked at it, and NFTs are all that. So, yeah, I mean, I feel like it's almost the opposite of last year. Like, you start to rally when they cut rates. Trump wins and all that. Opposite last year. This time, you end the rally when they cut rates. Probably October. I don't know if the odds have changed a little bit here. I mean, he did say September was kind of possible. But now, yeah, pause. But October, that's where you go. Alts are bouncing. What did I say? There we go. Man. What did I say? And this is just a lot of experience with this market, and a lot of experience with following things is how I get it right a lot. Not always, but how I can get it right a lot of times. So I would say that area is pretty significant on ETH right here. So yeah. I'm going to be on the because Bitcoin. Let me actually just take a look at, or actually, this is probably the same as the frickin', yeah, no change. Oh, okay. Probably no, yeah. I think October you'll see a cut though. Unless, yeah. But the, just wanted to, anyway, I'll be on because Bitcoin, shout out to them, but, did they even, yeah, I think it's in about a half hour or more, maybe 4:30 Eastern, something like that, so yeah. Independent central bank. Let's actually look at Bitcoin dominance. It's a good thing to look at right now. I don't think it's going to come up too much. I mean, a little bit. It could come up a little bit more. I think it might reject kind of from, 62. I think it's generally going to kind of come down. I mean, you got trigger waves forming and stuff, but I think this is pretty cooked. It's just my opinion. Surprise cut. I mean, maybe in September. I think more likely you would see that in October, the actual cut. And it's the irony of everybody gets excited October. Oh, they're gonna cut, and then they do cut, but things go down. Let's just look at fear and greed on. I don't think anything's changed since the last time we really. Yeah, 63. Is either going to go upward as things come up or downward. The thing too is like, you're right here. You could have another month before that. I would hope it jumps up a bit. You get a little alt rally. something there. It jumps up a bit over the next few weeks, and then you come down a bit. Last chance of those prices. It's just like the sentiment of people. It's like, oh, panic. Oh, yeah. I don't know. This could be the rally upward to new all-time highs. So we'll see what happens. But I'm still safe in this trade. So pretty good, and I'm holding that for now. Your funding rates are not bad. Not too many people are going long. I mean, some people are buying it up, but, you know, so I think we're okay. And I'm pretty excited. Anyway, guys, if you're interested, got a lot of really good deals for you guys. If you're interested in trading, check out BloFin, 25% off your fees for life. Nobody else is going to give this to you, I don't think. You can't find this nowhere else. 20% off your fees for life. Same thing with BYDFI, 25% off your fees for life. Only if you sign up my link. Even better, 25% off your fees for life with Bitunix if you sign up my link. Those are all in the description below. In addition, if you sign up to any of those exchanges, deposit at least $100. Make sure you open a support ticket in the Discord with your UID or your email, and I'll give you 1 free month in there. A lot of good stuff, swing trades, all that good stuff in there. So check it out if you guys are interested. So yeah, follow me on Twitter, Instagram. I don't know. It's probably the first time I've said on a live stream to do that. Powell's getting revenge on Trump. Yeah, I mean, it's not gonna. He'll cut when he's ready, man. I mean, Powell's gonna be out of here in 2026, and then they'll cut rates, you know, with the new one, and and nothing will really change, you know. I mean, the thing too is like it's kind of like law of averages. Like last bear market year, they were raising rates. Next bear market year, they're lowering rates, and it still goes down. You know, it's kind of just how it works. But we'll see. Anyway, guys, I think I may get going. I'll be on because Bitcoin's Twitter space in, I don't know, about a half hour. So I'll see some of you guys pretty soon if you want to check that out. Check out the links down below. Smash the like button. Hope you got something.